PayPal stock, ticker symbol PYPL, is up 34% in the past year. They are reporting earnings tomorrow after the bell, and in this video, let's do an in-depth analysis of the company, which includes calculating the intrinsic value of the company in order to determine whether this stock is a buy or not. Now, full disclosure, I own PayPal stock and I am currently up 42%, as you can see here. Looking at PayPal's revenue, they have grown revenue consistently over the past years at around 8% per year. However, this past year, revenue growth has decreased to only 4%. In my opinion, this is the main risk of investing in PayPal, which is the rising competition in digital payments. They used to dominate online payments, but now there are many strong rivals like Apple Pay, Google Pay, Stripe, Square, and even buy now pay later companies such as Klarna and Affirm. So it makes it harder for PayPal, but this does not mean that it is a dead company. Continuing with their financials, net income took a big hit in 2022. However, it has recovered nicely since then, and it is currently at $4.5 billion. This is a company that has more free cash flow, which is something that I really like. It also took a hit in 2022/2023, but it is currently at $5.9 billion. And if we take a look at their margins, profit margin has decreased and it is currently around 14% currently, and free cash flow margin is a bit higher and it is currently at 18%. One thing that I really like about the financials of the company is the number of shares outstanding. They have heavily bought back shares in the past couple of years. This is very positive for investors as you own more of the company. And if we take a look at the financial forecast, we are going to clearly see that PayPal is not a dying company. Their revenue is expected to go from $33 billion to $37 billion in 3 years. And EPS is expected to grow very nicely and reach $6.49 per share in 2027. If you assign a 20p to the company then, it would make it a $120 stock. So a lot of upside potential according to analysts. Then, in order to calculate the intrinsic value of the company, I use my spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. As a long-term value investor, I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value according to net income and free cash flow is different. Why? Because as we have seen before, they have averaged less net income than free cash flow. So I assumed a lower profit margin than free cash flow margin. And according to free cash flow, which is what I like to focus on, the intrinsic value is between $101 per share and $200 per share. And the stock is currently trading at $77 per share. This also means that if my low assumptions occur, you're going to make a 15% annual return on your money, middle 22%, and high 28.75%. So as you can see, very good returns according to free cash flow. I believe my assumptions are reasonable as I have the company growing 3% revenue annually for the next 7 years on my low assumptions, 5% on the middle, and 7% on the high. A profit margin of 14%, 17%, and 20%. A free cash flow margin of 17%, 20%, and 23%, which is what they have been doing. Then at the end of the 7 years, I assigned a P and price to free cash flow of 18, 20, and 22. And I assume they buy back 2% of their shares annually for the next 7 years. And if you want access to the spreadsheet, I will leave a link to it in the description below. It is very simple to use and you would get an in-depth tutorial on how to use it. This spreadsheet is fundamental when analyzing a stock. However, it does not take into account the balance sheet. But PayPal has a very good balance sheet with $11 billion in cash and $13 billion in debt. If we take a look at some valuation ratios, the P is 17, the forward P is 15, and the price to free cash flow is 12. So again, it looks very good. However, there are some risks in investing in PayPal. We have already looked at rising competition, but another risk is the slower user growth. If we take a look, active accounts have not really grown in the past years. However, transactions per active account have grown, which is very positive. The third short-term risk that I see is the US stock market overvaluation. I believe PayPal is undervalued. However, I believe the US stock market is heavily overvalued, which means a possible crash could come. If we take a look at the Shiller PE ratio, it is currently at 38, which is very overvalued if we compare it to history. This means that if the S&P 500 falls in price, PayPal probably will fall too. But this could be a huge opportunity to buy PayPal at an even cheaper price. Then another small risk is that we have a new CEO called Alex Chriss, so there is a bit of uncertainty about the future of the direction of this company. And finally, we have some macroeconomic risks, especially with higher interest rates. It could hurt consumer spending, which means fewer transactions and less revenue for PayPal. But again, I believe this could be a short-term issue. In conclusion, I believe PayPal is undervalued, and we will see in their earnings tomorrow. If it falls in price, it could be a huge opportunity to buy it at a cheaper price. I am personally not adding it to the stock portfolio at the moment because it is already my second largest position, and therefore I am personally waiting until it falls more in price. I hope you found this video valuable. Let me know what you think about PayPal stock in the comments, and I'll see you in the next one.